Good evening, ladies and gentlemen. Thank you and welcome to the Singapore Investment Week. My name is Richard Dyason. I think there's a little echo here today. Never mind, there must be two of me. More to hear. My name is Richard Dyason. I'm the General Manager for SIAS, and I'm here to actually talk to you about building your investment portfolio. Just want to show of hands, how many of you were here with us over the last weekend? So a fair few, half of it. And how many of you have heard of SIAS before? A little bit more. The rest, all right. So I'll just tell you who SIAS is. We're the this doesn't want to work as well. So 1 second. So SIAS, who are we? We work to make sure that investors are well informed. That's why we actually developed this Singapore Investment Week for investors to know a little bit more about investing, because we want to make sure that we have informed investors. Otherwise, silly investors always suffer. But we are here to make sure that investors always succeed. So just a little bit of disclaimer that whatever I say today is here for investment purposes only, and just to make sure that you actually speak to a financial advisor before you make any decisions. Before that, I'd like to make sure that we have an enjoyable evening, and so that we're just going to carry on. I think this is slightly better. We are known as a nation of savers. Actually, we have one of the highest savings rates in the world. Actually, about almost 50% of our GDP is actually saved, thanks, obviously, to our national savings scheme called the CPF, of which a lot of people forget that it's actually their savings. So they think you can use it. But, so we have to. But how many of you got children? How many children here? Children, one to a few, quite a fair bit. Do you tell your children to save? Save why? Save. Yeah, correct. But do we actually even say, are you investing wisely? How many tell our children that? A few. Yes, good. 1, 2. A little bit. We need more people to raise their hands. So we need to move from here. How do we therefore move ourselves from a nation of savers to a nation of investors? We can do that if we are more informed. So we're going to try and do that today. But before we obviously move to that, we obviously need to take care of our goals. Because today, our needs and wants, we have therefore to look in terms of our goals. We're not going to talk too much in terms of why the importance of investing today. We're going to talk about a little bit more portfolio, but anchored down on investing, you need to always remember what are our goals and how you actually do that. At SIAS, we actually spend a lot more. Actually, what I'm going to do today in 30 minutes, I usually cover in 3 hours. So you can imagine, I have to rush a little bit. So a lot of this will be on our website, and there's a lot more information also on our website, but I'm just going to try and take some of the things a little bit faster and focus on some of the things. Okay? Can? Only one. Anyway, are you okay? Yeah. Okay, thank you. So we have some agreement here. So I'm going to move this part and go a little bit faster. But always take note that we have to make sure our goals are very focused on. At the same time, while focusing on investing, we must make sure that we also don't put all our eggs in one basket. I always like to show this slide here talking about 2 chickens saying, how many times have I told you not to put all our children in one basket? So just highlighting the fact that. How then do we do this? So why is therefore a need to diversify a portfolio? Anybody know why? It's also a 4-letter word. What is it? Why? Risk. Excellent. Risk. Risk is one of the reasons why we have to diversify our portfolio. There is no investment, there is no risk. There is always risk in every investment. All right? So anybody come and tell you, no risk one, come and see me, I want to find out also. So there's always risk. And even putting your money into the bank, there's also risk. how do they cover? There is deposit insurance that helps you cover that. That's why the risk is minimized. All right, so insurance is yet another way of looking at risk. So now when we talk investment, so diversification across various asset classes therefore reduces risk. Now, is this the only way of reducing risk in investing? How many says yes? How many says no? How many say, whatever I do, you won't do it again? Okay, so majority said no, yes, correct. It's not the only way, all right? Obviously, as this highlight says, your best hedge against a down market is having lots of money. Obviously, hedging is yet another way of reducing a risk. We're not going to focus on that. We're going to just looking at diversification of portfolio today, okay? So let's do that. So before we start, we always like to make sure that what are our fundamentals, right? Going back to the fundamentals first. And this is where we always go back to say, what is our framework in terms for SIAS? And we have what we call the 3 dimensions for successful investing. Actually, we just launched a book on this, so I'm not going to cover too much of this, but I want to introduce this concept first, because fundamentally, we always must remember to go back to fundamentals, and this is that. So the 3 dimensions here, we're talking about knowing yourself, knowing the products, and knowing the strategies. So we need to understand these 3 areas to become a successful investor. I don't want to go too much into this. Again, this particular section alone, we also take another 3 hours to do in the workshop at SIAS. And they also have these things also on our website already. But I just want to remind people about the importance of these 3 areas. So obviously, knowing yourself is understanding your risk profile, also understood about the products, understanding what the products stand for, what are the features, and obviously knowing the strategies. How do you protect, whether you're doing long-term or short-term, and so whether they have growth strategies, we need to look at that. Now, as I said, this part I'm going a little bit faster. I just want to highlight this to you. So what happens if you do not know the right strategy, these 3? Just going to come here a bit.
So what happens? So what happens if you know the products and know yourself, but don't know the strategy? So there will be poor allocation of investments. What happens if you know yourself, know the strategies, but don't know the products? So you miss some of the opportunities. But what happens if you know the products and know the strategies, but don't know yourself? Then sometimes you'll be taking on a little bit too much risk than what you actually realize. Risk mismatch. So these are some of the costs of not knowing the 3 dimensions of investing. I also like to highlight that. We also have recently launched a book. Actually, the book is currently just available. It describes the 3 dimensions of investing, and we actually go through the various different products, the associated risk as well. So that is, we just launched that during the investment week. Actually, we have a special offer outside. And take a look at the book. See a little bit more for yourself at how you become a more successful investor. Now, we didn't come here to look at, so when we look at investment,
right, we also talk about what you want to achieve. Now, when we talk about investment, so when we talk about investment return, there really are 2 areas. So what is one of the first things when we talk about investment, people? What is it? What are you looking for? What are you looking for? Make money, right? My question is, how are you going to make money? So how? Price go up, right? So obviously, so that's what we call capital appreciation. But is that the only way of making money? No, all right? So there's also yield, right? You put your money in the bank, someone will give you more return, right? So there's also yield. So these are 2 really different ways of looking at that. So you want to look at when you look at products as well, look at your investment, you also want to look a little bit more about whether you're looking just at capital returns or you're looking at yield returns. A little bit later, we'll be talking a little bit more about REITs, right? So that will cover a little bit more about yield, and we'll talk a little bit later. So when we look at capital gains, we can actually look at whether your capital gains is whether you're living leveraged or unleveraged. For your information, all this today is also going to be recorded, and it will be on our website. And actually, all these are already on our website, so you don't have to. You can just pay attention and interact a bit there, okay, Ken? All right. So when we talk about leverage, so some of the leverage products that people are actually used to. So sorry, when you talk about yield, we actually generally talk about dividend from your shares. We talk about income, all right? Income is from some of the income-producing products. We'll talk about that a little bit later. REITs are one of the income-producing products. And obviously, you have interest. Obviously, interest, we all know there is not very much interest today, is it? So let's not go there. So let's look in terms of some of the products that we have here. Index futures, structured warrants, CFDs, FX trading, and also land and property. These tend to be what are your leverage products. And we need to, and obviously when we talk about leverage, you tend to be having to exposure far more than what you actually put in. All right, so we need to see how you use these effectively to manage so that you're not overexposed. So you need to understand your risk profile when actually trading and investing in some of these instruments. Right, when you look, I'm just going through very briefly, very quickly into these products because we're not going to focus on this too much today. When we talk about unleveraged, we can actually talk about investment styles. I'm now introducing two investment styles here. We talk about passive investment style. What do we mean by passive? That means you don't have to go in and monitor too much, all right? Examples like ETFs. ETFs are passive instruments. That means you put your money in there. It is through the index that actually automatically rebalances for you. For example, the STI index, all right? It's a mention of the top 30 companies. Now, do the top 30 companies always stay the same? Yes? No. Correct. No. So it automatically does that for you. Therefore, by investing, say, for example, you just go into the ETF, they automatically do the rebalancing for you. But obviously, when you talk about stocks, and if you want to do it yourself, you have to monitor. Correct? And obviously, you have to be active in always monitoring your stocks, all right? Always be active in watching it because there are always rights issues that you need to be aware of. A lot of times, investors always forget, hey, how I didn't do that, how come here? There are rights issues you must always, and the SGX net on the SGX website will always keep you informed in terms of what the rights issues are. And if you actually subscribe to the SGX My Gateway, every Friday there is an economic calendar. So those investors forget, watch out the economic calendar that gives you even some of the dividend yields, some of the rights issues that are coming up. If you miss, watch out the economic calendar and subscribe to the My Gateway that gives you also some of the updates around there. Now, obviously, some of the income-producing products, we talk about property. Property is one of the key areas. Singaporeans always property. We always like property. So REITs are one of the instruments that allow you to buy bite-sized chunks that give you a return. Now, the difference, I think we'll be talking a little bit later, a bit more about REITs. I don't want to talk a little bit more about REITs, but there is obviously business trust. Now, these are other types of like ships, and actually machinery. All these, they are actually developed into like a trust. And they're slightly different from a REIT. They're actually different governance structures, but they also give you income through their yield in terms of, that's how it's being produced. Slightly different from a REIT because as a REIT, it's a collective investment scheme that has to pay out 90% of its profits to investors, all right? A business trust does not have that requirement, right? So bear in mind that this is some of the differences between the business trust and a REIT. I'm just highlighting this very briefly, but actually there are whole articles written on this. Actually, they are also on the SGX website as well as the MAS website to tell you the differences between REITs and business trusts. Investors must know the difference. And obviously, we have our deposits from our interest from our deposits, which is, as we know, is not enough these days. It's only giving about 1.5%, 1%, whereas inflation is now currently at 4%, so eroding. So we need to do more, right? So if we want to do more, we need to figure out how we're going to do it. Now, this seems very complicated, right? There's a lot of colors around here. But I just want to highlight to you in terms of, this shows the best different asset class performance from 2004 to 2011. Now, I'm just going to read the top performing class in terms of small cap value, commodities, international stocks, commodities, long-term bonds, real estate. So if you're just looking at the best performing asset class, what do you think? Is it very easy to predict which is the best performing every single year? No. Even professional investors have difficulty in that. So obviously, when we talk about if it's not going to be easy to predict every single year consistently, then how then is best to structure something that is best suited for investors? So therefore, we have to diversify our investments across the different asset classes. And we'll talk a little bit more about this as we go along now. So I would like to put up this little cartoon. It said, yes, our investments are diversified. 20% out the window, 65% down the drain, and 15% gone with the wind. But obviously, we want to make sure that we are obviously, this must be a silly investor. Huh? We want to make sure you are a smart investor. So if we just look at this chart, all right, we'll just talk about why some of these situations, why therefore it's important to diversify. And this shows, if you look at this is in terms of the financial global markets, I'm just going to quickly highlight in terms of, when we talk about crises, every day there's one, and we feel that we have never even been out of one, and we just look for the last 10, 12 years or so. There are a lot of crises. We had the Kuwait War, Asian financial crisis, and it just goes on, right? And we see that the market is no longer it's actually very volatile, and the market moves according to a lot of these crises, a lot of information provided to you as a result of all this. Now, what about the Singapore market? Now, this is in terms of using the financial markets, global markets, benchmarks. What do you think of the local Singapore market? Is it going to be any less volatile? No. All right, this gives you an idea of the Singapore market. And this, we have three different asset classes here. We have the real estate in red, Singapore government bonds in this greenish color, and the STI in blue, and our benchmark inflation rate there. Now, if you look at in terms of the different asset classes, and you will find that, you will find that there is the effect of the different crises on the various asset classes. And what we're going to note that, while the STI is also be growing, what we also note that our favorite real estate is also moving but it's also at a very, is it less volatile or is it more volatile than the STI? More, all right? So it's more volatile. So there's also a lot of impact even in property and real estate markets. So I just want to highlight this to you, and we'll come back to another question later on this. So therefore, do not put all your eggs in one basket. What we do work as SIAS to actually make sure that you are informed and make sure you diversify across various asset classes using your risk profile. Now, this is just an example of how you can diversify your portfolio. A little bit more on this on our website, because we are just trying to make sure that people understand the concept of diversification in developing a portfolio today. We obviously recommend that you sit down and identify yourself first, understand your risk profile, and develop your profile, your portfolio accordingly. So, we always like to highlight this because right these days, you sit down, open a newspaper, make $1 million easily, right? You see these ads. So, I don't know whether this is something like this, get rich quick scheme, and is this a sort of portfolio we like to hold? Just a thought, I'm not saying anything. All right, so, I'm going to be, that's fast. All right, very quickly, just to say, it says a homework, just go back and revisit your own portfolio, find out what is it made up of. Have a look at this because it's always good and timely to review your portfolio. How many do this at least every 6 months? One. Once a year? Whatever I say will not do anything? So it is always important to go back and review your portfolio. Some people actually do this very regularly. Immediately when they hear a major impact, they can find that there's opportunity when they hear news. All right, so important news. So if you go back to our last chart, we saw whenever there's big, so news is the time for you to review. All right, so use information to help you review your portfolio to make sure that you are on the right track to your investment goals, right? So I'm going to highlight this. I also like to, I always put this picture up because a lot of times we talk about our own investments and we forget to highlight important areas like, did you take a loan to actually even get that portfolio up? Are we looking at even some of our exposures, all right? Because by taking loans and all that, it actually increases the risk of the profile of our portfolio. And this is something I always like to remind people of because a lot of times I forget to look at this. So just highlight this aspect. So now, question, 30 seconds. No money, no constraint. What asset class would you be, what investment would you do? Ma'am, what would you do tomorrow if there's no constraint? What would you buy? Good. What would you buy, sir?
I will buy a property.
Okay, actually, could you give this round of applause, please? Thank you. Okay, highlights the fact, actually, we've been doing this exercise quite a lot. A majority of Singaporeans will say, I want to buy a property. More than 50% of the time, they actually ask this. Yes, so everyone does it. But actually, in fact, that Singaporeans' exposure to property is actually growing, all right? It's actually very, very high. And given the fact that we saw earlier, so is property, so is real estate, is it very stable in pricing? Yes? So it's actually relatively volatile as well, right? So there is risk even in, therefore the importance of making sure our asset class are diversified. A lot of that we have very one-sided, we have stories to tell. I've been told that I have to quicken my pace a little bit more, so I will quickly do that and we'll come back to this in a few minutes. So important, therefore, to look, I'm just going to highlight this part in terms of, very quickly in terms of how we actually can actually diversify our asset classes, right? The foundations for, at the end of the day, the foundations for building a good portfolio goes back to, remember, okay, this particular chart here, okay, look. Oops, it doesn't like me. So fundamentally, we are always back down to our diversification based on our risk profile. Sorry, I missed the chart, so I'm just going to go back. This is the fundamental. So identify fundamentally how is your asset allocation done first before diversification. So we need to identify this. Identify the right asset allocation for your risk profile. And then diversify, all right? So then diversify, moving whether by market sector, industry, bonds, and the different types of bonds as well. So I'm not going to spend too much time on this today. So also note that there is a risk return for every different asset classes, right? So this is just very quickly in terms of there are different risk profiles for different asset classes, as well as a different risk profile based on the different investment styles. So you need to identify what is your risk appetite before you actually invest in some of these instruments. So questions to ask yourself, we actually have the 10 questions to ask yourself actually on our website. It gives you a little bit more detail, and we actually help you to identify even with the different asset classes, be it bonds, equities, REITs. We actually have this, so it's on our website. Just go and have a look and refer that to them. So I just want to always take a step back, is that a lot of times that why are we here doing this today? Because it seems that there are a lot of lessons we have yet to learn. We have actually learned from the last crisis, and we need to identify some of these lessons to learn. The first one is that, remember a few years back, it seems as though it has never ended actually, there was a general distrust in terms of the financial institution. Why? Because you didn't know the next day which financial institution is going to go down. Was it AIG? Was it Lehman Brothers? Lehman Brothers went down. Before that, we had some others. So Freddie Mac. So there was every day there was new finance. There was a general distrust. In this case, you did not know in terms of the counterpart. We're talking about counterparty risk, right? Recent as of last year, you heard of the there was another crisis. Some of you were trading CFDs, right? And another investment bank actually went down. And you are trying to figure out why. So there's counterparty risk in a lot of instruments we need to identify. So it was counterparty risk that actually, this is something that investors must look out for in the instruments they are trading. The other thing is that investors at that time did not read the fine print. They didn't know what was in their portfolio. A lot of them didn't realize that. So you need to also go back and read a lot of what's in the portfolio. All right, so this is some of the things that we want to remind people, go back. There's also a need for transparency a lot of times, that this is what investors are demanding for today. Liquidity. Liquidity becomes very important as well, because what is liquidity? Liquidity is when you can sell when you want to sell. Investors were finding that some of the funds they invested through during the last financial crisis, they had certain gates. Until today, I haven't found. I was reading through some funds. They say, hey, you have to actually apply to actually have your funds being released. So these take time. And when markets are very volatile, sometimes you can actually find that investors are wanting that more today. So, but at the same time, did we hear of any exchange closing during the last crisis? Yes? No. Exchanges continued to function. What does it mean? Therefore, exchanges help to minimize the counterparty risk, helps to reduce risk, right? So they continued to operate. There were no one closed, no exchange. How stressful the markets were. And what we also see, there is a movement towards back to basics, because there was used a lot of leverage, some of the products, and you will see that in today, there is greater rate review. There is a current review by MES in terms of some of the leverage going on in some of the products, and you'll find that is continues to be out there as well. So what is the impact for you? So therefore, when you develop your portfolio, you must have these factors in mind always, right? This is the lesson. We always must learn from history. This is something we need to review and remind ourselves as well. I'd like to just quickly go back to this slide. This chart is actually the long-term chart for the last 100 years of the US market. looking at the US equities. And really you can see a few things you can find out. The first thing is that about every 40 years or so, there's a crisis, right? 40 years or so. And you also can say that, based on the last 100 years, the market also goes, after every crisis, it also recovers. But does it go up in the same manner? Straight manner? It doesn't. Actually, it's so that is the other thing that we can say. So markets always recover in the long run. Right? Now the question here is that if you have 100 years, do you just put your money there and let it go there? That is it's also there lies. That's where your investment time horizon therefore becomes very important. So what is your investment time horizon? In this case, let me just say, if you're looking at the US equity market based on this, it gives you a return around 7%. So 6-7%, yeah, about 6% per annum. So if you have a investment time horizon along that, it just gives you the return of the market. So if you are therefore looking at just a 6% return, just leave your money and grow. Should be okay. But if you're looking to to outperform, in this case, do more, then you need certain strategies, right? Then you need certain strategies to actually do that. So how many of you want to know the secret to investing? 1, 2, a few only. The rest, you'll go. How many more? Yes, okay, a little bit more. Good, so you want to know the secret to investing? You have to stay invested. Right? Stay invested, but, right, very easy to say, just stay, right? You must know how to, all right? So here is, so the secret for you to successfully stay invested is to identify these things. What is the need for risk? What is your ability for the risk that you take? And the willingness. Now, why do I say what is the need? Why? Why the need for risk? Because what do you want? What are you looking for? Profit. Return. Correct. And I just said that risk, return. So you're looking for, so therefore, your ability. So, but at the same time, you need to find your ability for it. If it's too volatile, are you going to be happy? So depending on your risk profile, so you need to be able to understand that. All right. The ability to take risks. So sometimes you need to identify whether, how healthy are you. So these are some of the indicators, right? We actually do a lot more. I'm just going through very quickly in this today because we spend a lot more time on this. I actually spent about just half a day just talking about these 3 factors. And then your willingness to take this risk, because some people just are not risk takers. So therefore, you need to worry in terms of some of the questions you need to ask. I'm just given the time, so I'm just going to quickly go through this in terms of questions you need to ask yourself in terms of talking about the risk, in terms of need to risk.
So identify the right asset class, because if you have the wrong asset class, it can be actually quite difficult. Just now I showed you the return for the US market. If it was for the Russian market, it would have been very, very different. All right, so identify the right asset class. Then identify what is the return that you need. The word is you need, not what you want, all right? I know what people say, I want everything I want. 包個料. But what is it that you really, really need? If your need is 10%, identify what is 10%. And identify what is the expected return you're going to get. Look in terms of, obviously, the fees and charges do make a difference to that, as well as what are some of the alternative products that can actually help you achieve that. So these are some of the questions you need to ask in terms of need. You also need to look at the ability. We talked about what's the objective, identify in terms of the risk classification of some of the fund and your objectives. So identify, we just briefly talk about objective in terms of your goals, whether there's a need for liquidity. What is your investment time horizon is very important. We talk about this because all that makes a difference. What is your health because we talk about ability. If you are unhealthy, therefore your ability to take risk is lower. Whether your insurance is done. A lot of people say, hey, you need to make sure that your insurance is done. Always do your financial planning first. A lot of people say, so that I always recommend, make sure you cover your risk, cover yourself, because your family is also at risk there. And whether you are single or married. Married with 10 children, obviously less ability lah. Single, a little bit more ability to take risks. And obviously your investment amount. And therefore, look at your willingness, what sort of volatility can you take? So just for information, all these are on the SIAS website. We have videos talking about this to help you do. And we just talk about, conservatively, we talk about conservative in terms of, in this case, we use standard deviation as a means of to identify the risk. In terms of low risk, conservative about plus 3 to 3% as a means of for identifying risk. Balanced about plus or minus 8%. Aggressive, we're talking about 20% standard deviation as a means when we look at in terms of the classification of risk. So I come back to this question.
I'm just going to end right now. So I always like to ask, so which are riskier, stocks or property? True or false, sorry. Stocks are riskier to invest in than property. True or false? Right? True. How many say true? How many say false? Okay, slightly more say false. Okay, let me just highlight to you, I'm not stating whether it's true or false, that in terms of, this is some of the research done based on a profile, if you are looking at a portfolio that is purely just equities, more equities, we're talking about standard deviation of about 15%. In terms of between equities and stocks, about 19%. And in terms of where you skew it more towards just real estate, because we love property in Singapore, it's actually the standard deviation goes up. So when volatility, we talk is very equivalent to risk. So the higher, and therefore, the higher the volatility, the higher the risk. I think I don't have very much time right now. I'd like to just say thank you for this, and there will be a lot more actually on the SIAS website, and I'll be here around to take more questions. Thank you very much, ladies and gentlemen, and enjoy the rest of the workshop. Thank you.